Corporate Finance Excel Practice Problem. In this presentation, we're going to be looking at part 2 of our second problem related to degree of operating leverage, degree of financial leverage, and combined leverage. Get ready, it's time to take your chance with corporate finance. Here we are in Excel. We have the information on the left-hand side. We're going to put that into the blue area on the right-hand side. Last time we calculated the degree of operating leverage with our information on the left, and we did that in a couple different formats to see some changes and what the effect would be on it. So if you missed that one, you're going to want to go back and pick that one up because it's excellent. It's an excellent presentation. So in any case, we're now going to be doing this for the degree of financial leverage and the degree of combined leverage, as well as the break-even point, and thinking about how that fits into this concept of leverage. So remember that the leverage, if we think about leverage going up, we typically think that's going to be more leverage, and that comes with, benefits and costs. The cost being there's going to be more risk. The benefit is in times of good times, then it could lead to multiplying the gains in good times, could multiply the problems in down times. Okay, so now I'm going to hide some of these cells from E to I. So let's hide from E. I'm going to select E here to I and then let go. So we're in E, and then we're going to right click on the selected area, not on this thing, but on the selected gray kind of area down here. And we're going to hide those items. So now we're going to be looking at the degree of financial leverage formula. So we can do that two ways. We can take the change in net income or change in the earnings before income and taxes, or we can take the earnings before income and taxes divided by the earnings before taxes. We're going to do the bottom formula. It kind of depends on what type of data you have, in which case, in which item that you would be using or which calculation you might be putting together. So obviously the degree of financial leverage is going to have to do in some way, shape, or form with the debt that's going to be out there, because the varying factor will be the interest that we're going to be focusing in on. So we're going to then say, let's take the earnings before interest and taxes. So I can just pick this number up right over here. We're going to say earnings before interest and taxes. This might also be known as operating income. So you might be called operating income that you're going to be picking up there. If you just have net income, then you might have to subtract out, start at net income, and then subtract out the taxes and the interest expense. Then we're going to have the earnings before taxes. I'm going to do a little bit of a calculation here, even though we have the number, which is the earnings before taxes here. But if you didn't have that, you might start at the earnings before interest and taxes, which would be the 250. And then you'd be pulling out the interest. So we'd be pulling the interest, which would be the 70. And that would give us the earnings before taxes. And that's going to be the equal to the 250 minus the 70. Let's put an underline here. We're going to put an underline here. Now note again, we have that number in the way our income statement is formatted. If it weren't formatted that way, you might kind of back into this one, meaning operating income minus the interest, or you might have to go the other way, meaning you take the net income number at the bottom line and subtract, and then remove the taxes, or adding back, in that case, the taxes. Okay, and that's going to give us then the degree of financial leverage. Degree of financial leverage. And there we have it. This is going to be equal to then the 250,000 divided by the 180. Let's add some decimals here. We're going to go to the Home tab. Numbers group, add some decimals. We could keep going, but I'm going to stop at 2. So we're going to add 2 decimals. Let's put an underline here, and let's put a double underline there. So there we have it at the 1.39, the 1.39. Let's do some formatting. I'm going to select these 3 cells, go to the Home tab, alignment, increase the indenting. Select this cell, Home tab, alignment, increase the indenting. Okay, so that's the degree of financial leverage. Obviously, as this goes up, then that would mean that we would have more leverage as we go up, increasing risk, but also possibly increasing any gain related to it. Now, we're going to make a change, as we did with our prior presentation, the major change focusing in on the degree of operating leverage. So there's not going to be any change to the earnings before interest and taxes, or the interest. So there's not going to be any change to the degree of financial leverage, but I want to calculate that calculation again and note the changes that we have, so that when we then go to the degree of combined leverage, we have an idea of what we're adding together here. So we went down and we said we're going to increase basically the sales and I'm sorry, not this one. I'm going to scroll all the way down to here, where we said now we're breaking out a difference between the variable costs and the fixed costs, even though the earnings before interest and taxes and the interest and the earnings before taxes, they're all the same here, but there's a difference between the allocation between the variable cost and fixed costs, which increases the operating leverage because now there's more fixed costs as opposed to variable costs, but is not changing, will not have an effect or an impact on the degree of financial leverage. To prove that, let's go ahead and calculate the degree of financial leverage again. We did the operating leverage in a prior presentation. I'm going to do that with a formula because we're going to calculate it again. I'm going to say this equals, I'm going to scroll back up top. I'm going to pick up the amount here, or the name, and then I'm just going to autofill that down, putting our cursor on the fill handle, dragging on down. There we have that. Now I want to copy the formatting of the cells, so I'm going to go back up top. I'm going to select the entire box of or the blue part of it, go to the Home tab, Clipboard, Format Painter, then scroll on back down. I'm going to paint this across the entire thing. So there we have the formatting. Then I'm going to add our information. So I'm going to say that we then had the earnings before interest and taxes are going to be now the 250. So note that number's the same, even though we got there a bit differently because there's a difference between the cost structure of fixed and variable costs. Earnings before taxes, which again we already have down here, but we'll calculate it the way, just do a calculation of it. So the earnings before interest and taxes are going to be this item. We're going to subtract then the interest. That's going to give us, we'll subtract this out, the 250 minus the 70. That'll give us the 180, which once again is this number. You might in some cases need to start with the net income, earnings after taxes, and then add back the taxes. Might be something you'd have to do depending on the information provided to you. So then we're going to divide this out. This is going to be the earnings before interest and taxes divided by the earnings before just the taxes, the interest being the difference, the interest being related to, of course, the loan that might be in place, right? That's going to have to do with the degree of financial leverage. So we could see that 1.31 remains the same, even though there's a difference to the cost structure, because once again, the earnings before interest and taxes are the same, and the only difference we have here is the difference in the cost structure. There's no change in the interest either. Okay, scrolling back up then, now we're going to go to the degree of combined leverage. Now the one way you can do this is we're going to combine them, just as the name would indicate. You can multiply the two leverages together, the degree of financial leverage and operating leverage. Let's do that first, and then we'll calculate it again. So to do that, I'm going to unhide the cells now, going from column C to J. So I'm going to left click on column C, drag over to J, right click, and then so I'm on CJ. I'm going to right click not on this little thing, but somewhere in the gray area. I'm going to right click and unhide. So now we have our degree of operating leverage is 2.4, and we have our degree of financial leverage 1.39. So first let's multiply those together to get our degree of combined leverage. So I'm going to do that down here on the bottom. So I'm going to say this is going to be equal to, and I'm going to scroll all the way to the right. I'm going to pick up that 2.4, and I'm going to be picking up times, and I'll pick up that 1.39. So, and these are rounded numbers, so these are approximates because there could be more decimals. And then we're going to take the 3, I'm going to go to the Home tab, numbers, and we're going to increase some decimals. So we'll go to that's going to give us the 3.33. Now let's do the same thing down below. So we'll do the same thing down here. I'm going to say, all right, this one is going to be equal to, and I'm going to go all the way to the left, picking up the 3.84 times, and then I'm going to pick up the 1.39 and enter. Let's add some decimals. Go into the Home tab, Numbers group, add in a few decimals. We're at the 5.33. Now note once again that the operating leverage over here we can see is greater, and there's no change in the degree of financial leverage. So the operating leverage is greater on the bottom, and up top we can see the operating leverage is less, and the degree of financial leverage is the same. Therefore, of course, we would expect then the degree of combined leverage to be higher on our second scenario here, because there's greater fixed cost as relation to the variable costs. So now let's hide these items again, and then let's work our problem this way using the formula. So I'm going to go all the way to the right. I'm going to hide from column E. I'm going to select over from column E to column L. Let's go there. Left and right click on the selected area and hide that area. And now let's calculate our degree of combined leverage using our formula. A couple different ways we can do that. We can take the contribution margin divided by the earnings before taxes, or we can do what we just did before, operating leverage times the financial leverage, which we did down below, or we can do our percentages again up here. We're going to concentrate on the first one now. So we're going to start off with the contribution margin. So the contribution margin, again, we could simply take this number, the variable cost total, times the sales total minus the variable cost total to give us the contribution margin, or we can use the formula where we take the unit contribution margin times the units and times the units that we will have. Let's do that method. So that we're going to say contribution margin colon. So we're doing the numerator now, putting this in kind of like our, once again, our tax return kind of format. So we got the units sold is going to be the 12,000, and then we're going to calculate the contribution margin per unit colon, and that's going to be the unit price. So we'll pick up then the unit price, which is going to be the $90, and then the unit variable cost, that's going to be equal to the 40, and that's going to give us our contribution margin per unit, which will be equal to the 90 minus the 40. Let's go ahead and put an underline on the 40. Home tab font group, let's put an underline there. We're going to put an underline under the 50. Home tab font group underline there. Let's format these three cells by going to the Home tab alignment, increase the indenting. Let's increase the indenting here. Home tab alignment, increase the indenting. This is going to give us our contribution margin total, which is going to be equal to, then I'm going to say the 12,000 times the 50. And so we can even pull that out more if we want, all the way over here. And then, so that's going to be our top number. So that's in the outer column. That's the top number of our equation. Then we're going to have the earnings before taxes. So let's just pick that up. We have that over here. Earnings before taxes is going to be our 180. And that's going to give us our degree of combined leverage, which is going to be equal to the 600,000 divided by the 180. Let's add some decimals. We're going to go to the Home tab and the numbers, add a few decimals. Let's put an underline here. Home tab, font group, underline. So there we have it. Let's do it again for the second calculation. We've just basically proved this two different ways now, or we calculated it two different ways. Let's go down. Let's do it again. This time we're going to use the same formula. So I'm going to use our equal sign and go up top and pick up the same labels, and then we'll format the entire cell. So I'm going to say this will equal, scrolling back up, I'm going to pick the label up, enter. I'm going to use autofill to drag it down now. So autofilling it down. Then I want to format paint the entire cell, going back up top. I'm going to select this entire cell, this entire blue space, go to the Home tab, clipboard, and format painter. Scroll back down, and I'm going to put this on this entire blue space. So now we have the same formatting. Then we'll just calculate this again. So we're going to say the units sold. We're going to the contribution margin, our numerator, which we're going to calculate as the units sold, 12,000. Then the unit sales price per unit, $90. And now we have the change, which is the variable cost is only $10 now. That means our contribution margin is higher at the $80, our contribution margin per unit. And then our contribution margin total is higher at the 12,000 times the $80. So there we have that. We're going to be comparing that then to our earnings before taxes. This equals the earnings before taxes 180,000, that being the same number. This is going as the prior, that's going to be the 960 divided by the 180, and that's going to give us our 5.33, which matches what we got when we multiplied the operating leverage and financial leverage together. Now let's go do our break-even analysis. So we can, and you can kind of think about how the break-even analysis will fit into this. We've done the break-even analysis many times, so I'm going to do this a bit faster. I'm going to select N to Q, right-click on these cells and hide them. I'm going to scroll all the way back up top. Break-even analysis is going to be the fixed cost divided by the contribution margin per unit. So we're going to pick up the fixed cost, and which is going to be equal to the fixed cost of the 350,000. Then we have the contribution margin per unit, or let's say just in units, and colon, and that's going to be the unit sales price, which is 90, minus the variable cost. Let's say the unit variable cost, which is going to be 40. Let's put an underline here, home tab font group underline. That's going to be our contribution margin in units, equal to the 90 sales price minus the $40 variable cost per unit, $50 contribution margin per unit. Let's format this, selecting these three cells, home tab, alignment, increase, indenting. Select the contribution margin per unit, home tab, alignment, increase, indenting. That's going to give us our break-even point in units. That then, and somehow the fixed cost got lost up here. Fixed costs, sorry about that, is over here, the 350. So we're then going to say that we have the 350 divided by the 50 units, break-even units, then 7,000 units. Let's go ahead and underline this item. So now let's go down to our second break-even analysis with our second scenario. I'm going to then use our formulas to pull over the names, and we're going to say equals, scroll back up top, we're going to pick up the fixed costs. Then I'm going to use autofill, putting our cursor back on that item, autofilling all the way down with the fill handle. Then I'm going to format paint this, going back up top. I'm going to select the entire blue area up top. I'm going to go to the Home tab, Clipboard, Format Painter, and format paint this entire area. Then I'll do the calculation again, which we will have the fixed costs now being higher, fixed costs at the 710, whereas the unit price is the same at the $90, but the variable cost is much lower now at the $10, contribution margin then being higher, the 90 minus the 10. Therefore, the break-even point is now the fixed costs divided by the $80 contribution margin, and we need 8,875 units under scenario 2 versus the 7,000 units in scenario 1. So you can start to think about how the break-even point is relating to the financial leverage, the operating leverage, the difference between variable costs and fixed costs, because you will recall that the difference between these scenarios is the breakout between the variable costs and the fixed costs when the bottom line number for the earnings is the same. Okay, so we're going to just unhide these now. I'm going to put my cursor on column C, select over to column S, not clicking here, but clicking somewhere in the gray area, right click and unhide. So now we have our information. We got the degree of operating leverage, the degree of financial leverage, the degree of combined leverage, and then we calculated that a couple different ways, and then the break-even analysis for our two scenarios, the main difference between those two scenarios being the breakout between the cost structure, and then we had also our 10% increase with regards to the operating leverage, so you can see what the impact would be with that kind of change.